In the previous lecture, we covered both aggregate demand and aggregate supply. I introduced you to the concept that every time either aggregate demand or aggregate supply changes, it triggers the next phase in the business cycle. And then, of course, causes real GDP to rise or fall and can also impact the price level, or what we call inflation in the economy. Now we want to focus on just aggregate demand itself to understand, well, what is it that would cause the aggregate demand curve to shift? So if the aggregate demand is increasing or decreasing, what are the factors that are causing that to occur? So we're going to completely focus on the factors that influence aggregate demand. Now, aggregate demand is the relationship between total spending in the economy and the price level. So we refer to that as aggregate expenditures, the amount of expenditures that will take place in the economy depending on what the current price level is. Now, the total spending, the aggregate expenditures that occur are the sum of the expenditures by each individual sector within the economy. So you'll recall that there's 4 different sectors. We have the household sector, the firms, the government, and then the international sector. So we would add all of these up together. Remember, our formula would be C plus I plus G plus net exports, and that's what would give us the aggregate expenditures that are going to occur in the economy. Now, the total spending by each individual sector is influenced by completely different factors. In other words, factors that are cause households to spend more money are not going to be the same factors that would cause businesses to spend more money. So in order to understand aggregate demand, we have to understand the factors that influence spending in each sector of the economy. This is also sometimes called the non-price determinants of aggregate demand. So in other words, what are the non-price determinants of demand that will influence aggregate expenditures? Now you'll notice here that I've drawn 2 different graphs to the side of the slide. So when we're looking at graph A up here, again, both graphs are the same. They're both looking at the relationship between the price level and the economy and real GDP. And then, of course, I have the aggregate demand curve, drawn there. Graph A is illustrating what it would look like if there was an increase in aggregate demand, whereas graph B down here is illustrating what it would look like if there's a decrease in aggregate demand. So again, very simply put, if there's an increase in aggregate demand, your curve is shifting to the right, and if there's a decrease in aggregate demand, it's shifting to the left. So the first sector within the economy that we want to look at would be the household sector. And you recall that we defined household spending as consumption expenditures. So what is it that causes our consumption expenditures to change? In other words, again, there's different factors that influence us to spend, how much we spend on goods and services. So these are the 5 most common factors that are going to influence our consumption spending. The first one you'll notice we have listed is income. In other words, income is probably the most important factor related to our consumption expenditures. If income is increasing, then what that means is that households now have the ability to purchase more goods and services. So what should be happening if there's an increase in income would be what we see over here in graph A. It could cause an increase in aggregate demand, or vice versa. If there's a decrease in household income, then that means we're generally going to be purchasing less goods and services at every price level. So aggregate demand would be falling, like we see in graph B. Now, the second factor that influences the amount of money that household spends on goods and services is our wealth. And wealth is not the same thing as income. Wealth is the value of the financial assets that are owned by households. So, in other words, let's say you have equity in your home, equity in your cars, money in your savings accounts. Perhaps you have a retirement account with stocks and bonds. That represents your wealth. Wealth is what we call like a stock concept, whereas income is a flow concept. And so generally, if there's an increase in household wealth, then that will also act to increase our consumption expenditures. So again, it should look just like graph A. If our wealth is increasing, then that could cause household spending to increase, so aggregate demand would increase. Whereas if the value of households' wealth is decreasing, then it would have the opposite effect. In other words, it would look more like graph B because it would cause our household spending to go down. The third factor that influences household spending is expectations. And expectations is a pretty broad category. However, we know that consumer expectations have a major impact on household spending or consumption expenditures. And so expectations that can include like our expectations of our own future changes in income or wealth. So let's say, for example, that reports start coming out that make it seem as though a recession is imminent. That's going to impact the expectations of households in terms of worrying whether they may lose their job, maybe their hours are going to get cut, their income may fall. Therefore, you would generally see a decrease in household expenditures because of those change in expectations. So expectations, we know, are a major factor that influences how much households will actually spend. If we feel more favorable about the economy, favorable about our job, our income, we spend more. But if we don't feel very favorably about the economy, then we tend to spend less and save more. The fourth factor that influences consumption expenditures is the demographics of society. And demographics can affect consumption expenditures in a couple of different ways. One way would just be simply if you have population growth. So let's say that you have more people living in your economy, the population increases, then that would mean you have more people buying goods and services. So therefore, consumption expenditures should increase. However, let's say we're talking about the demographics in terms of the age makeup of your society. That's a little different. What we generally see is that younger households and older households generally consume more and save less, whereas if you have a larger proportion of your population that is middle-aged, then they generally spend less and save more because that's when you're usually saving for your retirement. So again, the age distribution of the nation can also impact the consumption expenditures. And then the last category that influences consumption expenditures is taxes. Basically, let's say the government raises taxes, so now households have to pay higher tax rates, then that's going to lower the amount of disposable income that households has. So it's the same thing as saying that there's going to be a decrease in consumption expenditures. Whereas if the government lowers tax rates, then that's the same thing as saying household disposable income is going to increase, and that should effectively increase consumption expenditures. And so again, the idea here is any one of these factors that is increasing consumption expenditures is going to have the effect of increasing aggregate demand, like we see up here in graph A. Whereas if any of these factors are changing that are going to cause consumption expenditures to decrease, it's going to look like down here in graph B. It could effectively decrease aggregate demand. Now, the second sector in the economy that we want to examine would be the businesses. They also spend money. They're currently the third largest spender in the economy. And you recall that we called business spending investment expenditures. So household spending was called consumption, whereas business spending is called investment. And what you notice that the factors that influence investment expenditures are completely different than the factors that influence household expenditures. Firms are primarily concerned with profits and more specifically how to maximize those profits. And so most of the factors that are going to influence investment expenditures are dependent upon how they think that it's going to impact their profitability. So one of the number one factors that influences the amount of money that businesses spend is interest rates. There is a relationship between investment and interest rates. Generally, the higher the interest rate, the more costly that investment expenditure is, and that tends to cut into their profits. Therefore, there's a negative relationship between investment expenditures and interest rates. If interest rates go up, then that's going to cause investment expenditures to fall because, again, it negatively impacts the profitability of that investment expenditure. So you'll notice that I've drawn an example right here to illustrate how that can impact aggregate demand. So again, let's say that there's an increase in interest rates. Again, theoretically, what we believe is that that's negatively going to impact investment expenditures. So if investment expenditures fall, that can actually cause aggregate demand to decrease. The second factor that generally influences investment expenditures is technology. In other words, generally when there's new technology emerging, that's going to stimulate investment spendings. Basically, as firms are then forced to adopt new production methods to stay competitive. In other words, if you just decide, oh, I'm not going to invest in that new technology, but all of your competitors are, you lose your competitive edge in the industry. So anytime there's new emerging technology, that generally causes investment to increase. And so you'll notice that I've drawn an example for that down here. So again, suppose that there's new technology in the economy that's going to cause businesses to invest in that new technology, and so that should have the impact of increasing aggregate demand in the economy. The third factor related to investment expenditures would be the cost of the capital goods. Now remember, capital goods are the machine and equipment, things like that, that are purchased by firms to use in the production process. So let's say that those machines and equipment start to get more expensive, in other words, the price rises, then the higher cost associated with the investment will again lower the expectations of the profitability for the firm, and so we should see investment falling. So again, that's going to look just like the graph that we did up here, where same example like when we said if there's an increase in interest rates. So again, if the cost of capital goods increases, it would cause investment to fall, which could cause aggregate demand to decrease. And then the fourth category that we have that influences investment expenditures is simply capacity utilization. The more excess capital, or what we call unused capital goods, there are available, the more firms can then expand production without purchasing new capital goods. So then that would have lower levels of investment. However, if a firm approaches full capacity, in other words, they're utilizing all of their capital goods, and the only way that they can increase production is if they acquire more capital goods, then they're going to have to invest. They're going to have to spend money to get those additional capital goods, which would cause investment spending to increase. And again, that's going to look just like the one that we had down here. So again, as firms reach capacity, what that does is cause an increase in investment expenditures, which we know can effectively increase aggregate demand. Now, the third sector of the economy that spends is the government, and you'll notice that I have very limited information on the government. That is because government spending may be set by government authorities that is completely independent of current income or other determinants of aggregate expenditures. And so we are going to cover government spending extensively when we cover our chapters on fiscal and monetary policy. So for now, all you really need to know about government spending is that the government gets to decide how much money they're going to spend. They can either increase or decrease their expenditures at will. All right, and the last sector that we need to cover in terms of aggregate demand would be the international sector. In other words, we have to look at the value of our net exports. Now, you recall that net exports was simply exports minus imports. What we assume is that exports are basically going to be determined by conditions in the rest of the world, and imports are going to be determined by domestic factors. So every single time one of these factors changes, they also can ultimately impact aggregate demand for goods and services. So the first factor that can impact the value of our net exports would basically be income. And so we can be talking about income of our economy domestically or income of our trading partners and what their income levels are in other countries. So let's say that we're talking about the income level within the US economy, and let's say that that income increases. So if we believe that household income is increasing, we already know that we're going to increase our expenditures on goods and services. However, that we're also going to be increasing our expenditures on goods that are imported. And so if we are spending more money on imported goods, what that will do is cause net exports to fall. So notice right here in this graph right here, this is the impact we believe it could have on aggregate demand. If there's an increase in domestic income, which causes us to spend more money on imported goods, net exports falls, which means aggregate demand actually will decrease. Whereas let's say we're talking about income of our trading partners, so there's been an increase in foreign income. Well, that's going to have the opposite effect. If the income of foreigners is increasing, then they're going to buy more of our goods, so our exports are going to increase, so net exports will actually fall. So in other words, that's what we would see going on right here. In other words, again, if the income of our trading partners is increasing, then they're going to buy more domestic goods, and that will cause our net exports to rise. I think I accidentally just said they'll fall. I'm sorry for that. Net exports will rise, and if our net exports rises, that could actually cause aggregate demand to increase. So again, you can see these two different graphs here illustrating what would happen depending on whether it's domestic income that's increasing or foreign income that's increasing. Again, what it does is it alters the value of goods being imported and exported, which is why they have opposite effects on aggregate demand. Now, another factor that can influence net exports would simply be prices of goods and services relative to our trading partners. So basically, if there are higher foreign prices, then that's going to make domestic goods relatively cheaper, and that would actually increase our net exports. So that would look more like graph B down here. I guess I didn't label it B, say graph B down here. Whereas if it's the opposite, if there's lower foreign prices, then that's going to make our domestic goods relatively more expensive, and it would actually decrease net exports. So then it would look more like graph A up here. Now, something that's directly related to prices would be exchange rates. In other words, remember we talked about in our chapter with exchange rates that even if the price in the country doesn't change, if the exchange rate changes, then it ultimately changes the price for the foreign countries that purchase the goods. So if there's a depreciation of the domestic currency in the foreign exchange market, then it's going to make the domestic goods cheaper to foreign buyers and make foreign goods more expensive to domestic buyers. So of course that would effectively cause the net exports to rise, whereas an appreciation of the domestic currency will have just the opposite effect. And then the last factor that influences the international sector or net exports would simply be any kind of government policy that's in place that ultimately will alter the net exports value. So that would be if suddenly foreign government started to restrict the import of domestic goods into their countries, or if our country did the same thing. So any kind of barrier to trade that was imposed could ultimately impact our net exports. So just to recap, we do see that the aggregate expenditures that occur in the economy depend on many different factors related to the four components of total spending in the economy. So in other words, first we talked about household spending, which we defined as consumption expenditures, and we had all those different factors that influence consumption expenditures, so income, wealth, demographics, expectations, taxes, and again, if any of those change, it alters consumption expenditures. Then we talked about the investment expenditures in the economy. And so remember, we said investment expenditures was going to be influenced by whatever the current interest rate was, if there's new emerging technology, if the price of capital goods is changing, or if firms are reaching capacity utilization. And if any of those change, then investment expenditures will change. Then we talked about government expenditures very briefly, and I basically said, well, the government gets to decide how much money they're going to spend on goods and services. And then the last sector within the economy was the international sector, which we measure through net exports. And we know that net exports are influenced by income of the domestic country relative to the foreign country, of the prices of the domestic country relative to the foreign country, what the exchange rates are between countries, and then of course if there's any government policies that are going to alter trade. And so we add all of that together, and that's what gives us our aggregate expenditures. And remember, aggregate expenditures is simply the relationship between spending in the economy and whatever the current price level is. And so if you're thinking of it graphically, so you have your aggregate demand curve that slopes down like this. Every point along this aggregate demand curve represents a different level of aggregate expenditures depending on what the price level is. So again, you have the entire curve that represents aggregate demand at all the different price levels in the economy, whereas each point along the aggregate demand curve again represents the actual expenditures. So the expenditures that are going to take place, what real GDP is going to be depending on what the price level is. And anytime one of the components related to, factors related to the different sectors within the economy changes, what we call the non-price determinants, that could actually cause the entire aggregate demand curve to shift. And so again, we see something like this. In other words, the aggregate demand can either be increasing or decreasing anytime one of those non-price determinants is changing. So before we wrap up this part of the lecture, let's briefly review. Household expenditures will decrease as a result of what? So which one of these factors would actually cause household expenditures as a whole to decrease? Well, we know that if there's an increase in population, that's going to cause household expenditures to increase, though that can possibly be the correct answer. If there's lower personal income taxes, then we know that that increases disposable income, which would actually cause household expenditures to increase. So that would not be the correct answer. If there's a decrease in household wealth, again, that means that households are generally going to spend less money on goods and services. So that would be the correct answer. D says an increase in consumer confidence. Again, that would influence our expectations and cause us to spend more, so that cannot be correct. And then E, an increase in household income. And of course, if our household income is increasing, then our household expenditures are going to increase, so that would not be correct. So the only correct answer here, the only factor that would cause household expenditures to decrease would be if we have a decrease in household wealth, whereas population growth, lower personal income taxes, increased consumer confidence, and an increase in household income, those would all actually cause household expenditures to increase. Other things equal, investment spending will increase when what? So A says interest rates are lowered. Well, if interest rates go down, we know that positively impacts the profitability of an investment. Therefore, yes, theoretically, if interest rates go down, we should see an increase in investment expenditure. So A would be correct. Whereas B, C, D, and E, those are all examples of where investment spending would actually decrease. In other words, if any of these occur, then we're going to see a decrease in investment expenditures. If they're operating under full capacity, then there's no need to invest. They already have enough capital goods. If interest rates peak, meaning interest rates are going up, then investment expenditures will go down. So again, A, B, C, and D would all cause a decrease in investment expenditures. And then this question says, which of the following will cause net exports to rise? A says a depreciation of the domestic currency. So if our currency is depreciating, what that basically means is our goods are going to become less expensive to our trading partners. And so if our goods are becoming less expensive, then theoretically our exports should rise. And so if our exports are rising, then that's the same thing as saying our net exports should rise. So A would absolutely be correct. If there's a depreciation of the domestic currency, then that should effectively cause net exports to rise. Whereas B says a fall in foreign income. If there's a decrease in foreign income, then that would mean our exports would fall, which would mean net exports would fall. If there's higher foreign tariffs on domestic goods, then that would mean that we're not going to export as many goods because of those high foreign tariffs, which again basically means exports are going to fall. If there's lower foreign prices, then of course that means that we are going to import more of those goods, so our imports will rise, which means net exports will fall. And E says a depreciation of the foreign currency. So if the foreign currency is depreciating, then that means their goods are now relatively less expensive to us, so our imports will rise, which will cause net exports to fall. So B, C, D, and E, these are all going to cause our net exports to fall. Whereas a depreciation of the domestic currency, that will cause net exports to rise. And then one last review question. Let's say that I said I wanted to know what could cause the aggregate demand curve to shift to the right. Now remember, if the aggregate demand curve is shifting to the right, that's the same thing as saying aggregate demand is increasing. So we're looking for one of the non-price determinants of aggregate demand that we identified would actually cause the aggregate demand to increase. So A says people become more pessimistic about the future economy. Well, what that would alter is our expectations, and so we know household spending would actually go down if we were more pessimistic about the future, so that certainly would not cause aggregate demand to increase. So we know that A could not be correct. B says there is a decrease in foreign income. Again, if there's a decrease in foreign income, then that means the amount of exports are going to fall because they're not going to be purchasing as many of our goods, and so that would cause net exports to fall, which would not cause aggregate demand to increase. C says government spending decreases. Again, if the government is decreasing the amount of money that they spend, then that means, the value of G is declining, so aggregate demand would certainly not be increasing. D says foreign price levels decrease. If foreign price levels decrease, then that means that we're going to purchase more goods and services, so our our imports are going to rise, which will cause our net exports to fall. So that would not cause aggregate demand to increase. And then E says foreign price levels increase. This would be the only correct answer. In other words, if the foreign price levels increase, then that makes our domestic goods relatively cheaper to theirs. So if our goods are now cheaper, then that should cause the value of our exports to increase. We'll be exporting more of our goods to our trading partners, which will cause net exports to rise, which should cause aggregate demand to increase or shift to the right.